Welcome to The Explainer. Today, we're breaking down a real head-to-head battle between two of India's absolute auto giants, Mahindra versus Tata Motors. We're going to dive deep to see which of these titans really comes out on top.
Now, you've definitely heard of both of these companies, right? They make cars, they're household names. But here's the thing. As investments, their stories are worlds apart. So the big question we're tackling is, which one might be the better bet for your portfolio over, say, the next 3 to 5 years? Let's figure it out.
All right, let's just dive right into it. And you know what? We're going to start with the conclusion first. We're looking at the top-line verdict from the detailed comparative report. This gives us the answer right away, but the real story, the interesting part, is understanding the why behind it all.
And boom, right out of the gate, the scoreboard is pretty clear. Mahindra, or M&M, scores a solid B grade with an accumulate rating. Tata Motors passenger vehicles, or TMPV, gets a C grade and a hold. But honestly, these grades are just a headline. The juicy part is the story behind these numbers.
So, to really get what's going on with those ratings, we've got to pop the hood. The fundamental difference between these two companies is what actually powers them. You can think of them as having two completely different kinds of engines.
So on one side, you've got M&M, which is this really diversified, all-Indian machine. It's got two powerful engines that kind of balance each other out. Its super popular auto division, with the Thar and Scorpio, and its market-leading farm equipment business. This whole setup gives it incredible stability. But then you look at Tata Motors, and it's a totally different story. It is overwhelmingly powered by one single massive engine. Its international luxury brand, Jaguar Land Rover, or JLR. I mean, this makes up nearly 3/4 of the company's entire revenue. So buying Tata Motors is basically making a direct bet on the global luxury market.
And this quote just nails it. This is the single most important thing to understand in this whole comparison. You've got one company that's a stable, diversified domestic player, and another that's really a high-stakes, high-reward bet on global luxury. This one difference explains pretty much everything else we're about to see.
Okay, so we've established these two very different business models. How does that actually play out when you look at the money? Let's run a quick financial health check on both of them.
So if you look back over the last 10 years, M&M has been a picture of consistency. It's only posted a loss in one single year, and that was right at the peak of the pandemic. That's a seriously resilient track record.
Tata Motors, though, well, it's been a bit of a roller coaster. It went through 4 straight years of losses before staging its recent and, let's be fair, very impressive turnaround. This just highlights that boom and bust nature that comes with relying so heavily on JLO. And that difference shows up big time on their balance sheets, too. M&M's core auto and farm business is practically debt-free, super clean. That gives them a ton of flexibility. Tata's story is different, but it's also a great one. It's been an incredible comeback story, aggressively slashing its massive debt load, nearly in half.
All right, and this is where the plot really thickens. Because if you just look at the price tag, one of these stocks looks like an unbelievable bargain. But the question is it a genuine opportunity or is it a value trap?
I mean, just look at these numbers. The price-to-earnings ratio, which is basically the stock price compared to its profits. Tata Motors is trading at around 4 times its estimated earnings. M&M is way up there at 29 times. Any way you slice it, on every single metric, Tata Motors just looks dramatically cheaper.
So you're probably thinking, okay, this is a no-brainer, right? If it's that cheap, Tata Motors has got to be the obvious choice. Why on earth wouldn't you buy the stock that's trading at a tiny fraction of its rival's price?
But, hold on, here's the catch. It's cheap for a reason. And that reason has 3 letters, JLR. The market has priced in this huge discount because of the massive binary risk tied to Jaguar Land Rover. The entire investment case really boils down to one question. Can JLR pull off a very difficult and very uncertain turnaround? Okay, so we've looked under the hood at the business models, we've checked their financial health, and we've puzzled over the valuation. Let's bring it all together and look at the final scorecard from the full analysis. And there you have it. It's a pretty clear win for M&M. It scores a solid 72.1 out of 100, which puts it firmly in that B-grade camp. Tata Motors, while still a giant company, scores 52.8, landing it a C grade. So why the big gap? Well, if you dig in, you see M&M's victory is built on what we call quality factors. Things like better growth, a much better risk-reward profile, and stronger business fundamentals. Tata Motors' wins, on the other hand, are mainly because it's an undervalued turnaround story. And this idea of risk-reward asymmetry really tells the whole story. With M&M, the analysis shows a 1.65 to 1 potential upside versus downside. That's a really attractive setup. Tata Motors is basically balanced, meaning the potential gain is almost equal to the potential loss. For an investor who's conscious about risk, that makes a world of difference.
So, what's the bottom line here? It's not really that one is good and the other is bad. It's that they're for two completely different kinds of investors. M&M is for someone who wants a stable, core holding in their portfolio. Tata Motors is much more of a tactical, special situation bet for an investor who has a much higher appetite for risk.
Look, if you want to go even deeper on this, the detailed reports for both stocks and the full comparison are linked right down in the description. And hey, make sure to drop a comment and let us know which comparison you want to see us tackle next. Signing off from Stress-Free Investing.